let us understand what Heiken Ashi is. Just like candlesticks, Heiken Ashi is also a charting technique that helps us understand the movement of price over a particular period of time. The Heiken Ashi charts are a bit similar to candlesticks. Just like candlesticks, Heiken Ashi charts are time-based. Therefore, on a daily chart, one Heiken Ashi bar will represent the movement of the price during one single day. So, why should we use Heiken Ashi charts instead of regular candlesticks? The biggest advantage of using Heiken Ashi charts over candlesticks is that the Heiken Ashi charts help us in identifying the trends with ease. This is possible because there is a continuity of candles in Heiken Ashi that the candlesticks charts simply cannot offer. For instance, look at this chart. Here we are looking at the same price movement on both the charts. The only difference being, on the left we see Heiken Ashi charts, while on the right we see the regular candlesticks. Now, let's say that you entered a buy trade at the very first candle. Then as the price moves on, we see red candles appear on the chart. These red candles were just small pullbacks on the price. But when you are trading in real time, these candles can make you think about your trade, and you may fear the worst. So you may exit your position at one of these candles. However, if you used Heiken Ashi charts, you can see that the Heiken Ashi candle stayed green throughout the price move. Therefore, you could have held on to your position throughout the price move. This is what Heiken Ashi charts are used for. Heiken Ashi charts are really useful for spotting out clear trends in the market. The main aim of any technical indicator is to reduce the market noise on the charts. The Heiken Ashi certainly helps us in achieving that. This happens because Heiken Ashi charts are calculated differently. The open of each candle is calculated by adding the open and close of the previous candle and dividing it by 2. And the close of each candle is a simple average of the open, high, low, and close of that particular bar. Now let us understand how to read Heiken Ashi charts. So Heiken Ashi charts are really simple. In an uptrend, we see that the bars are green in color and have negligible or no lower wicks. This indicates that the price is moving upwards with momentum. Then, when the momentum starts to decrease, we see the green candles start to have lower wicks. This is the first sign of weakness in the trend. Then, we see a red candle. This is a sign that the trend might have come to an end, and we may expect a down move. Similarly, in a downtrend, we see that there is a continuous occurrence of red candles that have negligible or no upper wicks. This is a strong signal that the market is moving downwards with ease. Eventually, we see a red candle with an upper wick. This is the first sign of weakness in the downtrend. And the following candle is a green candle. This indicates that the down move may be over and the price might be ready to make a higher move. So now, let us discuss a very powerful trading strategy that will help you predict price moves with high probability. In this strategy, we will identify potential areas of reversal and look for a certain Heiken Ashi candlestick pattern at these areas. First, let's talk about the candlestick pattern. If you have been trading for a while, you might have come across the inside bar candlestick. Inside bar is a simple 2-candle price pattern in which the body of a certain candle is completely within the range of the previous candle. This means that the candle is completely inside the previous candle. Hence the name inside bar. Inside bar is a reversal pattern. So, if we spot an inside bar pattern, we can expect the market to make a reversal from the previous price move. Now, inside bars are very powerful on the regular candlestick charts. But they are even more powerful on Heiken Ashi charts. For instance, look at this chart. Here we see an inside bar on the Heiken Ashi charts. The range of this candle was completely inside the range of the previous candle. So, this was an inside bar candle. If we look at the recent price movement, we can see that this inside bar appeared after a strong down move. Since it is a reversal candlestick pattern, we can expect the price to make a higher move after this inside bar. And as you can see, the price made a higher move. Now, we will not trade the breakouts of every inside bar pattern. We generally have two types of inside bars: a bullish inside bar and a bearish inside bar. A bullish inside bar has only two rules. Rule number 1. The inside bar and the previous bar, both should be green. And rule number 2. The inside bar should occur after a substantial up move. This is a bullish inside bar candle. Here we see that the inside bar and the previous candle are both green. And the pattern appears after an up move. So this was a valid bullish inside bar. Whenever we spot a bullish inside bar pattern, we expect the price to make a down move. So we will look to sell below the low of the pattern. If the price breaks above the high of this pattern, we will not buy. When we spot a bullish inside bar, we will only look for selling opportunities. On the contrary, we have the bearish inside bar. A bearish inside bar pattern has two rules. Rule number 1. Both the candles should be red. And rule number 2. The inside bar should occur after a substantial down move. Here is an example. This is a perfect bearish inside bar. Both of the candles in the pattern are red and the pattern appeared after a substantial down move in price. So when we spot a bearish inside bar, we will look for buying opportunities. If the price breaks above the high of this pattern, we will buy. But if the price breaks below the pattern, we will not look to sell. Now, as I mentioned before, we will not trade alone based on the inside bar pattern. But we will look for potential areas of reversals and wait for the pattern to appear at these levels.